who else do we have? Yeah, Florian from XR Nanotech. Well, I think all of you are, I don't know if it's because we filtered to only Epic members, but at least all of the people I can see here are Epic members. So let's just wait 2-3 minutes till people are kind of all coming in. Simon Schwinger, but he's not looking for money. I think maybe if you're not looking for money, Simon, that means that you're here to give money. Is that why you're here?
Let's see how the discussion is progressing.
But I'm not aware of Jabil doing any investments. Do you do investments to acquire companies once in a while?
We do, yes. We just did this year, so we are doing this. The reason I'm dialing in is because we are cooperating and working together with startups quite heavily, and we see some early startups especially doing some mistakes when they are engaging with larger corporations. So maybe we can have some insights.
Okay, well, I didn't know that, and now that I have you, Simon, I owe you the answer about the end users at the committees, by the way, which you're correct about your statement that the guys. I'll reply to you, but you're right. These were not end users, but they are the most end users that we kind of have. The guys who are on that AR/VR community, they don't have customers in the Epic membership. But yes, I still owe you an answer for that. But just so that you know, what we have is we have a list of companies who are looking for money, a list of companies who are investing, and the investors could be a VC, corporate, something like that. So if you are active in that field or looking for companies as an Epic member, you're welcome to reach out to me and say, Carlos, we're looking for these kind of companies. We have so much money to help, for pre-seed or something like that. So if you are actively doing that, then you can always have a separate call with me and we can record your profile, your investor profile.
That's good. Thank you.
Yeah, you're welcome. So I'm going to give it one more minute, I think, before we start, so that giving everybody a chance to join in. You're always welcome to turn on the camera. I think it's always much nicer to be able to see who is there. And again, probably many of you know each other because you're most of you are members of Epic. Yes. And Torsten Lubinski, we have not yet met. I know you're a member of Epic, and I remember you think you're something on the medical stuff based in Berlin. Is that correct?
Yes, that's correct. However, it's not Torsten Lubinski. I'm just about to change my name. It's Baron Meyer because Torsten Lubinski is busy right now. We had to have a short exchange of people coming in. I hope that's fine.
Absolutely. As you have seen, I would not have noticed, but yes, I remember the company. I have not visited your company, but I remember that you were kind of a user of Photonics on that side.
Yes, exactly. For glucose measurement.
Okay, good. Vicente Calvo. Now I have you here. Are you ignoring my sponsorship emails for the AGM, or did you not get them?
No, I got them. I will answer to you that one offline. Don't worry.
It's so funny because you have several people here to whom I owe an answer. So it's like, okay, guys, for all the emails that I have not answered, we can go through them right now.
Yeah.
It's so nice that we're just always that same community. So Neringa, I don't know if you see a lot of people still joining in, or when do you want us to start? 5 minutes have passed. Do you still see a lot of people coming in?
No, I think that the peak already ended.
Okay, so then I suggest, they will still be coming in, but I suggest that we kind of start. I don't know if you have to click something for that recording part or if we're just good to go.
We're good to go.
Okay, well, thank you all very much for joining. This is an investor session, and as you know, in my direct responsibilities, anything that has to do with investment, I take care of at Epic. There is a lot of confidential information. There is a lot of company strategy, so I kind of take care of that myself. Today's meeting is actually part of 3 EU projects. So if I can just share my screen over here. Epic is involved into some EU projects. JEPIC's fabulous MedFab, I'll go into that in a second. But all of these projects are manufacturing pilot lines. So Epic doesn't get into projects because it needs the money. We welcome the money and we get paid for what we do, but that's not the reason we're into that. We're into them because they're all about manufacturing pilot lines and scaling up. And I'm not that I'm a big fan of that, but maybe you have heard of the sentence, small is beautiful. Doesn't apply to diamonds, doesn't apply to businesses. So we want companies to grow. These 3 projects are all related to photonics, but different kind of technologies. JEPICS is a European funded project which has to do with photonic integrated circuits, in particular indium phosphide and triplex photonic integrated circuits. So again, multi-project wafers, scaling it up, the manufacturing side. They have calls. So if your company is involved into photonic integrated circuits and specifically into this 3,5 indium phosphide triplex technology, please take note that there could be opportunities for the European Commission to help you in the funding of prototypes and in the scaling up. Similarly, Fabulous, which is a fantastic name, I love it. It's just like Epic. I think it's a great name. Epic, by the way, is an accident as a name. It was supposed to be EPIA, the European Photonics Industry Association, and very grateful to the solar industry, the photovoltaic industry. The name EPIA was already taken at the time, so it became Epic, for which I'm very grateful because I think it's just a great name. So here you have a Fabulous association, and they are all involved, again, EU-funded project, which will be sustainable in the future, but they're dealing with all what has to do with free-form micro-optics. They have members who are in the whole value chain. They have funding from the European Commission. So if your company is making products or is part of this value chain of free-form micro-optics, please contact Jessica Van Eck, and she will be able to connect you with that and see and express how she will be able to work. The third project over here is MedFab. MedFab stands for Photonic Medical Technologies. And so they accelerate the commercialization of diagnostic devices and instruments. So if you're dealing with medical based on photonics, feel free also to reach out to this project because they have funding to subsidize part of the development of prototypes or the scaling up. So all of these products, as I said, have to do with commercialization of photonics-based technology products. And I particularly like this scaling up aspect. The program for today, as you can see, we have 3 companies involved who will be talking more on the investor's perspective side, but we have a combination. Noel Moore, he is with Focuslight, so it's a corporate investor, and here specifically will be on the acquisition side. Tim Rea, when he joins, they are really a VC, UK-based VC. And then we also have Ronald Mueller, who has a very broader perspective as a consultant, and especially for the vision markets on his tips and tricks, what he calls the 5-phase playbook for company sales and investment. And then we have 2 EPIC members. Well, these are also EPIC members. Vision and Markets and Focuslight also, but we have 2 companies who will be sharing their expertise. And that's the agenda. So the presentations will be 10 minutes, followed by 5 minutes of Q&A, where I expect all of you to be very active and to be asking questions and just engaging with all of us. I don't think that I forgot anything for the logistical part. I think that's it. You can mute yourself, so for the background noise, and otherwise, you can raise your hand or just unmute yourself afterwards when you go for the questions. So I think we can just start directly with Noel. Noel is with Focuslight. You can start sharing your presentations, Noel. Focuslight, which acquired not Innerlight, please, Limo. Sorry. You acquired Limo in Germany. And you have also yourself a huge, I guess, 30 years industry experience into that. So we look forward to your experience. And as much as you can talk, you have many of these presentations, how to prepare your pitch, but as much as you can share on as the company. So you have a lot of companies over here. When you're talking to the audience here, which is composed of companies who make components, systems, fibers, lasers, medical devices, spectrometers, cooling systems, here another laser equipment. As these companies are growing, which EPIC members always do, as they are growing, they will be needing money. Most of them, all of the guys here, unless you have nothing else to do, but all of them will be needing money. As they grow and scale up, what is it that they should have in mind in the context of raising capital? Because most of the time you scale up and you kind of think like, how do I design my product? Which partners do I find for the manufacturing? What is the most efficient way for manufacturing, the bill of materials? But on the investment side, are there considerations? So anything along those lines. With that, Noel, floor is yours.
Okay, everybody, can you, first of all, can at least people hear me and see my slides? Is that the case right now?
Clear.
Loud and clear. Very good. Okay, let's get going then. So hopefully, let me just click to the next slide. Okay, now you've seen the slide change. Okay, so today, firstly, thanks to EPIC and Carlos and Naringa for the invitation. I don't expect that you're going to see a one-size-fits-all from all the participants today, but you may see some commonalities and you may see some unusual ideas and concepts that maybe one person or other may bring up. In the spirit of Epic, I'd invite people to collaborate and openly contact each other later on if they wish to. So I'd like to talk a little bit about investment, strategic partnerships, and particularly M&A, and how to prepare your photonics company for the conversation, potentially with a bigger partner who may acquire you and potentially integrate you and so forth. So I'm Noel, Chief Commercial Officer at Focuslight, and one of the things that I focus on is identifying and preparing companies to have those discussions with our individual business units and so forth. So I'll talk about three different things very briefly because we don't have a lot of time. One is preparing for the discussion. And what should you do when you know you're going to have those calls and what those calls need to look like? Two is an element of self-evaluation and reflection. And then finally, evaluating the fit. I know others on the call will talk about valuations and other such things, but these are the three topics I want to drill down on. Firstly, in terms of preparation, you're going to need paperwork, NDAs, financials, etc. But I think you need some thought into this. I think you must know your business and be able to describe it. And I would say that's significantly different from knowing your technology and being able to describe it. Many times when we have conversations, people say, so tell me about your company. And we get very wonderful, very interesting conversations of, higher order nonlinear effects in unusual crystals. Very interesting. And we have plenty of people, including myself, who thrive on that. But that's not your business. That's your technology. So I'd encourage people to, as Frank Levison and Milton Chang both said, your businesses are defined by your customers. So the technology is one thing for sure, but what's the business story? Where are you now and where are you going? And that's less to do with where the technology roadmap is. Of course, it's built on the technology roadmap, but it's really to do with who are the customers and where are we going to be going? So it's the markets and applications. As again, Frank and Milton have both said, business determined by its customers. And what I mean by this is the conversation and the partnership can be quite different, equally valuable, but quite different depending on your customers. So for example, if your product is primarily going into universities and it's a wonderful technology, that's a story. It's a good story and it's an interesting story. It's a different story than if your product goes in at a commodity component level into the consumer electronics market. And a lot of times what I've found is people are very well understanding the application, but not so much understanding the market. So in other words, they understand what they can do. They don't really understand what their customers are trying to do and what the pressures on the customer will be. So that's often a challenge. Of course, look, all your data may be present, it must be present and correct. You'd be very surprised how often I ask somebody, could I see your last 5 years of revenue and net profit? Or could we have a list of your patents? And they're not actually available. So I know it sounds like general housekeeping, but you do need to have that in your hands because it also gives you an idea of, are your technology positions and are your financials reflective of the industry you're in? So for example, are your gross margins aligned with your potential acquirer or investor and so forth? Again, with regard to financials, it's not just the numbers, it's what do the numbers tell us? Can we look at the revenue breakdown by product, by application, by region? Because that's going to highlight weaknesses, it's going to highlight strengths, it's going to highlight areas where we can collaborate and improve, and areas where we have genuine weaknesses together that we need to address. And I'd encourage people greatly to think from the viewpoint of the business, not from the viewpoint of the founder. And that maybe sound quite obvious, but a lot of times the stories we will hear are stories of the founder's roadmap to where they are now. But actually what's more interesting is, where is the business going to go following some sort of a collaboration? And then I think we need to be honest about, what does this deal facilitate? Is it growth or is it retirement? And a lot of times the honest answer is, look, I've done this for 30 years and I need to go and other people need to take it forward. That's a conversation for a glass of wine over a nice dinner. The story for the business has to be one of growth, and it has to be one of future growth. And I think one of the things that's really going to be important is, A lot of smaller photonics companies, and most photonics companies are small, a lot of times the people and the relationships are built around founders and core members of the team. And if they're not going to continue with the new venture, that's something that needs to be addressed early on. Again, it's not a problem. It just needs to be openly discussed and addressed right up front. So I hate SWOT analysis, but as I was putting together these ideas, it kind of fell out this way. So when you look at your strengths, don't think about your products particularly. Of course, they're good, but think about your capabilities. Think about your competences and what they can be applied to. So you may be looking at spectroscopy, but you may actually have volume manufacturing scalability in one of your processes that can be quite interesting. Think about your current strengths, but also your strength after investment. So an M&A, the purchase price that they talk about, that's the price to play. That's the price to be able to make decisions with the management team. It is not the investment roadmap. So once the deal is done, there should be a plan for investment and scaling and so forth. So look at what your strengths are now and what your strengths could be with other technologies, other team members, investment, financial, etc., other things like that. And you should be asking exactly the same questions of those partners. I'd also say, especially at the moment, talent is very, very highly valued, but of course, also attitude. But talent at the moment is the currency in our industry. In terms of weaknesses, I think you need to be honest about your struggles. I find a lot of people saying, like most of our sales are in Germany, let's say. But the truth is they have never had a successful sales team in China, as an example. And as a result, they have to be honest and say, maybe we don't fully understand the Asian roadmap for our business. Most often, I find that there are weaknesses in the sales team and in the knowledge of the applications and the talent for getting into those kind of strategic customers. Help is probably available in the company that wants to acquire you, or indeed there are help people on this call who do sales consulting and whatever. I can connect you to them. And then in terms of the opportunities, you really need to know what you can do alone. So where is your business going anyway? If nothing happens here, where are we going? Because that's your baseline story, right? That's where you're going to value your business. And then what can you do together? Is there a special synergy that only these two things coming together can solve? If there is, that's definitely going to put you in a premium position for conversations. It's going to accelerate things, and it's going to increase your value. And then what gaps can be filled and need to be filled in each direction? It may be that you have a team that does something you consider trivial, but the acquiring partner may be struggling with that particular competence. So don't undervalue what you can do. And then threats, things like key team member departure. You know, if you have a founder who's the key technologist and he's leading discussions on sales and he's leading partnership discussions and he's going to retire, that could be an issue. Again, not a deal breaker, just need to plan and have a roadmap for how to overcome it. And again, the biggest threat is always going to be culture clash, so to be aware. In terms of the fit, I'd always say don't assume too much, either in a positive or a negative way. There could be a better fit or a worse fit than you think. And sometimes you might look at a company and say, oh, those guys do solid state lasers, they're not interested in us. But you don't know their roadmap, you don't know where they're going. Investigate that. Look at what kind of talks they're giving at Epic or at whatever, Photonics West, Clio, whatever. And I also always like to go and look at who they're hiring. So if it's a telecom company that's always done 1550 nanometers and now suddenly they're hiring 2-micron experts in holmium fibers, you know something new is happening. So again, small investment in your time here, you might get a little bit of roadmap information. Even if the technology is fundamentally different, if the end customers are the same or somehow related, this may be a fantastic fit. Your sales team, your applications team, your product development team may all be already working in that space. And there could be huge synergy, even though the actual technology is addressing different parts of the customer need. So don't overlook that as a huge value. Again, the culture is very important. Even if it's a great fit on the technology and commercially, the culture will be key. And I think you need to take time to have many discussions, not just about the big picture, about the nitty gritty. How do we do things in Europe? How do we do things in the US? Because that's really going to be the currency by which you live or die. And again, remember, you're selling a business, not a technology. So the story has to be about growth. It has to be about partnership and innovation. The end market engagement, most companies like us and others, we accept technology risk. That's what we do. We don't tend to accept market risk. So if you have a product you think can go into medical world, but you've never sold in that world before, that's a big question mark. Again, a very interesting question mark, very excited, but it's going to require diving deep, talking to those end users and making sure that that's in fact correct. Again, lead customer acceptance. Are your customers going to accept the scale and adopt your product in larger volumes once you might be part of a bigger organization? Because that would be the goal, right? And then a key thing, really, this is really a struggle for most people. Are your forecasts real and achievable? Is there any essential element missing? I would caution people, if you don't have a good view on that, there are consultants available, reach out to one. It's money well spent to put some reality checks on your forecast because it also intimately affects your valuation. And then finally, from, let's say, a Focuslight perspective, but I don't think we're different than anybody else, what are we looking for? We're looking for market awareness and certainty so that you know your market, you know what price points they want, you know what technology they can accept. Of course, technology risk to get there, that's what we do every day. We like that, but market certainty and market awareness. Growth and margin need to be aligned to our plans. And I think this is true for all acquiring companies. So if you've been growing 10% year on year, and we have targets of 30% growth, we need to make sure that that's going to be aligned. You don't want to be the lagging business unit in a larger company. You want to be equal terms and getting a fair share of R&D funds and fair share of other attention. In terms of partnership, I think your key team members need to be very excited by the possibility. So you do find people who've done things the same way for a number of years. And when a new company comes, especially if they don't know the company, they tend to have an inherent reluctance about things. I would say before you have the conversations, get your key team members together and say, guys, this is on the table. This is something we're going to look at. I want people to understand what it means for the company, but what it means for each of you. You don't want to be having these conversations with the acquiring partner in the room. And I've seen it happen. You don't want to do that. And then the culture. It's not just, whether it's big company culture, small company. It's the teams that have to work together and integrate. Are they going to thrive? Do you have the right innovation match? Do you have the right market aggressiveness match in your sales team? Do you do things similarly or in the same way? So that's, for me, that's a huge thing about being successful. And then to summarize, I think I'd like to see that you're doing well on your own, but you're going to do significantly better with us. So with that, I hope I didn't go over time too much. I've put my email and my phone number here. Happy to take questions. And thank you for listening.
Thank you very much. It was straight to the point, lots of things. I bought this for myself. I don't know if with the camera, with a fake artificial background, if it's visible, but I have this sand clock, which I use for myself for being focused. I tend to be distracted. It's exactly 5 minutes. So we're just going to open it up for questions from anybody in the audience. Any questions, challenges that you would like to share with Noel? So you can unmute yourself or just raise your hand. I can see Mike is raising his hand. So you can just unmute yourself, Marek, please.
Hi, Carlos. Hi, Noel. Marek Kotliński from Vigo Ventures here. Very happy to be here. A lot of friendly faces. Hi, everybody. A lot of new ones. Also, again, hello. Noel, from your experience, the points that you've given are very, very relevant from the point of view of the later growth expectancies of the companies that are to acquire you. As we focus on the early stages, pre-seed and seed investments, that the teams are comprising out of engineers, PhDs, scientists. what is your approach or experience in determining the key success factors of those teams at the earlier stages, not to overwhelm them with the expectancies at the M&A, but still need to plan ahead on what needs to be furnished or established in the company from the very beginning, as we are looking at photonic, deep tech, semicon companies that will require further financing, that will have a longer time on the commercialization or reaching the product market fit. How not to overwhelm the companies, but really plan ahead from your perspective and experience. Thanks.
Yeah, it's a great question, Mark. And actually, I've done a startup or two myself, so I've been that person in the past, and maybe will be again one time. What I've found is that the culture that makes startups so exciting and so fun to work in, you know, there are no CEOs, there are no junior engineers, everybody's doing everything, and that's wonderful. But a lot of times what you don't have is, I would almost call it traceability. So at the very earliest stage, you know, you're focused on getting your product working, you know, getting in front of a couple of key audiences. So a lot of times you're not necessarily documenting your roadmap a little bit, and questions will come up later on about, you know, is this protected? Did you get a freedom to operate on this particular technology, etc.? And the last thing you want to have that do is come up at an M&A time. And then the second thing I'd say, and I know some of the other people, Tim and others, are going to hit on this point probably a bit more than I will. One of the mistakes I find startups make all the time is they don't ask for enough money. And I know that's, you know, wow, crazy. If I ask for €1 million, I might get it. But if I ask for 5, maybe not so much. You're better off asking for 5 if that's what it is, or whatever the number is, because what you're good at is you're good at technology and innovation. You do not want to keep spending every 12 or 18 months coming back to make another pitch deck, running around all the VCs and seed capital, post-seed capital people. They're great guys, but they're busy too. What we'd rather see is that the guys would look at the roadmap and say, look, if there's one document they always overlook, it's the cash flow. So when are we going to be cash positive? You know, yes, your IP is great. Yes, you have this fantastic hockey stick revenue, but when are you going to stop needing money? And that's the number we need to build towards. And I think people think, you know, I better not be too greedy. I better not ask for too big amount of money. But I've had very sophisticated investors tell me, actually, you need 2 million more than you think. Here's why. Go back and cost that out properly. Build in some delays. Everything is going to go wrong, not right in terms of timing. So I'd say those two things. Traceability on your documentation and so forth. It's a small thing to do day by day. It's like cleaning the kitchen. If you clean it as you go, it's better than at the end of the session. And then the second thing is pay attention to how much money you really need. Cash flow document is the master.
If I can shortly follow on comment on that, I completely agree with you that the structuring of building up the maturity, not only of the technology, but the maturity of the company itself and making it ready to fundraise more is something that we see that has been overlooked in many cases of the companies that are raising round A and the other letters of the alphabet. And coming that and starting to do that early, it's a must-have. But on the second point, it depends. It depends. I'm going to answer like a lawyer. It depends, because you might have a company that will be revenue driven and will be able to do those revenue projections and give you some estimates connected to where the money will come from. But other companies, very early stage, this will be a crystal ball. Those will be guesstimates of the revenue stream and the cash flow. And there might be companies that, if they're IP and technology driven, will make a different potential M&A or exit case that won't be a revenue multiple at the end of the day, but will be a technology push, but not a solely technology push without a market recognition of the problem that needs to be solved. But still, the hockey stick projections won't represent the true potential, because, for example, it will be very, very difficult to estimate the true sales potential, because, for example, the sales won't be done by the company itself, but by their predecessor, by their successor after they're being acquired, for example.
Yeah, absolutely. I think you're totally correct on all of those points. That was one of the reasons I mentioned, for example, a sales consultancy. Like if you have a product that you intend to sell it to a big consumer electronics company, you probably can't, afford a business development leader who sells into those companies. These are expensive people, but maybe some consultancy on that front can get you in the door to validate your argument. So I find exactly what you're saying is correct. It does depend on where in the life cycle of the company that the acquisition is likely to happen. And a lot of times acquisitions, as you know, can be scaling acquisitions, but oftentimes they are enabling and empowering acquisitions. So without the partnership, you're not getting there. Whereas other times you're going to get there faster or bigger or better, but you might have got there on your own in the same market. That second type of empowering acquisitions or enabling acquisitions, a lot of times that can be something like market access, but it can also be about adding on a source to your optics or an optic to your source or whatever else. And now you go with a solution. So, your points are very well made, and absolutely agree with you.
Thank you. Marek, maybe you can introduce Vigo Ventures, because we have in the room two investors, yourself and AMS Agora, and maybe 30 seconds, how much to invest in which fields?
All right, very shortly, we invest across whole Europe. We invest in pre-seed and seed stages of the companies. We invest up to 1.5 million euros with possibility of follow-on financing within this cap. Within our investment group, we have two limited partners, which one is a technology backbone partner, Vigo Photonics, 35 years on the market, epitaxial growth division, a couple of hundred people on board, and Warsaw Equity Group, which is a privately held investment firm, which gives us the cascade possibility of financing on the later stages of the growth financing, which they contribute up to 10 million euros of investment.
Super, thank you very much.
Thanks.
Marek. And Jan Meiser from AMS Technologies Agora, if you can just, how much to invest in which fields are you interested?
Sure. At AMS Technologies, we're looking for companies which have revenues of somewhere in between 1 million and 5 million euros, and which are, somewhat borderline profitable or profitable. And at Agora Ventures, we're looking at pre-series or seed investment or pre-series A at anything up from 500,000 to 2 million.
Okay, thank you very much. Because remember, Zoom has this thing, you can chat individually in private as well if you want to do that, and you can also put your contact details if you want to do that. So we can have this discussion. And we also have 3 people going to help you find investments. So I'm going to ask Accept and Vision Ventures and Amiris if they want to. I think I read recently that Amiris is also helping into that. But just again, 30 seconds, maybe Andreas, how can you help the companies?
Yeah, well, we are, I'm a consultant with my own, genuine experience being an entrepreneur, starting a business from a company or from an institute, going into a, global market and finally selling it to one of the global players. So, and I'm more than happy to share this experience, with young entrepreneurs. And, that covers, from starting and writing the right business plan, over the growth, and organization, topics, and finally also, selling companies. Sometimes that goes hand in hand, partner people or companies I work with then go from one stage to the other. And that's, more than welcome to do that.
Thank you very much. And Gabriel Janssen, if you want to say in 30 seconds about yourself, how can you help companies in which fields?
Thank you, Carlos. First of all, I would like to ask Noel to thank also Mueller for his excellent presentation. I think you hit it spot on what the challenges are for sellers, and these challenges are multifold, I would say. And this is one area where we can help. Vision Ventures is an advisory for corporate transactions, specifically in the space of vision technologies. And we support sellers, buyers, also investors, also younger companies looking for investments, and we provide help over the whole process, starting from how to describe your business and not your product, but also one point you also mentioned, Noel, identifying the companies in the field that should be most interested in such an acquisition, knowing the technology development, knowing also the roadmap of potential acquirers to make sure that that bringing companies together who are a good match.
Thank you very much. Yeah, sorry, I interrupted you. I think you wanted to finish the sentence.
only another half sentence, and here it is of course helpful to have an advisory that are experts in a certain field and not just general run-of-the-mill corporate transaction advisor.
Thank you very much. And you've been in Vision for a long time. And I know, Marika Kurova, you're the only one from Amires who turned on the camera. So I will take that as a sign that you want to tell us, how can Amires help in 30 seconds? How can you help our members?
Yes, thank you. So I'll take the floor on behalf of Amires, but I must say that Amires Investments is a separate legal entity. So it's not directly what we do, but what our, let's say, daughter company does. I think the idea is mostly to provide support to newly set up businesses, advisory, and help with fundraising. So not directly investment as such.
Yeah, super. Thank you very much. And we also have a Vision Markets, but you will be making a presentations after. So, but we have several members also who help. Several of our members are part of this ecosystem to help you. Our next speaker, Tim Rea. Tim Rea was introduced to me by somebody else, but I forgot, but I'm very glad. Maybe you will remember Tim who introduced us. But you're a VC based in the UK. So I think we're just gonna leave it to you. You know, you see pitches all of the time. You have a lot of experience, and these companies who are here, almost everybody in the audience are CEOs of Photonics companies. What would you like to tell them? 5 to 10 minutes, and then we'll have 5 minutes discussion. Floor is yours, Tim.
Okay, great. Thanks, Ronald. So I think we were introduced by someone who I had approached to have due diligence support for a company that we were looking at, and you very kindly responded, and the conversation has developed out of that. But just very briefly, hopefully some of the points I'll run through, kind of really reinforce some of the other parts of the discussion. Very brief introduction from my perspective. I started life in corporate R&D in optoelectronics, as it happens. And actually, very keen to kind of progress things beyond, kind of playing around in the labs. So I spun a company out, raised some money, and actually, enjoyed every part of that, but faced some challenges in dealing with investors, not just raising money, but even, how do you engage with them? How do you manage them and keep them in the right place post-investment? And at the end of that process, I stepped into a venture capital fund, and I've now been investing for a little over 20 years. I've been party to more than 200 deals, and I often joke that I've seen what I think is almost every conceivable way for things to go wrong. A few things have gone right. But I've been through a couple of full fund cycles. I have been working with BGF, which is a UK-based fund, for 5 years now. And BGF is a strange entity that has fixed capital, so we have a lot of flexibility in terms of the time frame over which we support, how we structure things, and just generally how we invest. We have invested £3 billion over the last 11 years. We are typically investing 500 to 600 million pounds a year. And within that, I have built an early stage franchise, which is almost exclusively deep tech focused. And so within that, we are looking at a range of technologies, but there's a bit of a concentration in life sciences, a bit of concentration in the deep tech aspects of clean tech. And then there's a more general deep tech bucket, which would include some things in the optoelectronics, photonics space. Quite pleased to say publicly, I think as of yesterday, we can announce that one of our investments, Luminicity in Southampton, has been acquired, and that was a nice investment and a nice exit for us and a nice exit for the team there in hollow core fibers. So just to launch in at a very high level, I occasionally am asked things to do with, how do we go about fundraising? And going back to my own experience, how do we manage that? And I recall reading a generic article, it's probably in an in-flight magazine somewhere, about an actor whose big breakthrough came from the realization that he was way too focused on solving his own problem of landing a part, and that he should instead focus on solving the problems of the people on the other side of the table, because it's probably far harder to try to find somebody to fill a part than it is for the single actor kind of going around trying to land a part. And that really struck me as applying with fundraising. It's not really about you getting money. Of course it is, but it's far better, far more productive probably for you to think about it in terms of solving the problems of the people on the other side of the table. So what are my problems? I don't expect you to feel sorry for us poor investors, but my job, very generically, is to generate a return on capital. So simple terms, buy low, sell high. But in more detail, I really need to be able to go through the process of assessing the risk profile of a business. And then I need to work out, based on that risk profile, what sort of return on our investment would justify recommending this investment. And I need to convince a bunch of people on my side that those things are kind of balanced. I need to then understand in fairly precise terms how much capital a business needs in order to achieve its objectives. So how much money do you need to be able to raise? Do we need it all now? Do we split it up? And I then need to be able to assess the potential value creation and exit routes. So who's going to buy this and for how much, and what evidence can I find in the market for precedent transactions? And what comparable quoted companies can I find to underpin some of the sense of how the market values this sort of thing, and values it as a function of revenue or a function of profits or gross margin or growth rate? And if I put all of those things together, I really can then start to get a sense of where the valuation needs to be, and sometimes whether or not the business is viable in the first place. And it is actually surprising how often you go through that exercise and you think, this doesn't make sense. You'd like to think that actually, for some of the businesses we invest in, just incredibly smart people, really hard problems to solve. But sometimes when you work it all out, it might not actually make economic sense. Particularly, kind of if you haven't thought carefully through some of the details. So I have to go through most of that myself. It takes quite a long time. And one of my biggest issues is just purely capacity. So if I look in the last year, I theoretically could have invested 110 million pounds this year. I had pre-approval to invest on that level. I'll probably land on about 65 million pounds. And the issue isn't a shortage of deals that are theoretically viable. The issue has been the time it takes to kick those deals into shape, to figure out all of that stuff and get to a viable proposition that I can put on the table. And once in a while, and it is really only once in a while, I get a company that makes things easier. And maybe that's once a year. And it's dangerous. And I'm not advising that you kind of figure it all out and show up to an investor with the answer, kind of on a card. But it is smart to think through some of the required inputs. And I think some of the advisors that were just a moment ago kind of introducing themselves, some of those people will have a good sense of how to put together some of the background information if you haven't gone through the process before. But what does this business look like at maturity in terms of how it makes money, who it sells to? And we invest in some companies that are going to be acquired before they make money, and that's fine. But the buyer is going to need to make money, so it boils down to the same thing. What comparable companies would you point to as examples? What is the typical financial profile, typical margins? What can you point to in terms of supporting cost and pricing assumptions, and supporting volume? What's going on in your market? Who's raised money? Who have they raised it from? What valuation? Who are the buyers, and what are the transactions you'd point to as what you want to achieve with your business? My life is so much easier if you have that data, and it's easier for you to get it and be communicating with your peer companies and kind of understanding, kind of some of those data points that you can just hand over and allow me to kind of plug into my model. So I think, an appeal to be thoughtful in terms of the inputs that I think investors need to think through their process, because even if they're not going to invest, the quicker you get them to that decision, the better off you are, because it'll save you a lot of time. And just to finish off, I think the key things that we spend a lot of time debating internally, technology, what have you got that's proprietary and sustainably differentiating? what are investors going to find on Google when they search your headline terms, and how do you supply the info up front that allows them to position you clearly in that mix? And some investors will also be looking at downside protection. So, they'll of course want the upside, but if things don't go to plan, is the technology and IP strong enough to support the recovery of their investment, in a downside scenario? Second, validation. So what can you point to in terms of validating the technology, but also, the potential commercial opportunity? One of the things I think is very interesting in our business, doing a lot of investments in the life sciences space, every life sciences company has a network of key opinion leaders. So these are people that they would put on the table and say, they're only moderately conflicted in terms of being aligned with a company. But if we're telling you a story, we know that you're going to need to go and validate some things about our science, some things about the market need. Here are some people to talk to. We'll introduce them straight off. You can go have a call. They understand who we are. And you don't have to take it all, kind of at face value. You can get some stuff that you need to go away and validate. But we'll get you started by introducing these key opinion leaders, KOLs. Third thing would be market size and potential. Is it big enough? If you can argue and defend a case for a 5 billion market, an investor can accept that you could be successful with a single-digit percentage market share. If the market's $250 million, I'd really need to be convinced that you're going to own the market, and I'd probably want to invest and engage quite late stage when you're starting to show the traction and direction of travel. And the fourth thing, and the thing that you really have control over, is the team, which is really critical. Is it reasonable? You can ask yourself, is it reasonable for an investor to hand over the amount of money we're asking for? It's easy to sort that out, and at the very least, a business should have a super solid finance director, and it's easy to put in all of the controls to actually look deserving of the capital that you're trying to raise. And then we have the legals, which have the potential to be a big headache in getting a deal done. There's the negotiation around points that are probably going to be unimportant in the scheme of things. But lawyers are very good at stretching things out, and they don't get paid as much if we do things quickly. But it really does make sense to dig in and understand early on, what are the key points that are going to be contentious? What are investors trying to achieve in those points? Can we satisfy that, have a clear discussion, and save ourselves 4 to 6 to 8 weeks of running around in circles and running up the legal bills? I've got all of that off my chest now. I can probably leave it there.
No, that's perfect for the time it allows for questions. So I see that we have, I'm going to give it first to first the person who put in the chat, and then we'll give it to Peter and Marek. But Simon, you put a question in the chat. I mean, it's nice to hear from you. You can read your question yourself.
Yes, I can do that. Thanks for that talk right now. I don't know if that's possible. The bullet points that you listed or you mentioned were very useful. So maybe we can have it like in a written form. That would be awesome.
Sure. Well, I'll send that back. Yeah.
My key question is, Jabil operates and works together with startups, and most of them are usually heavily funded, I would say, in the range of 50 to 100 million, 400, and even in the billions, right? So, but there are also smaller ones, like starting in the range of 5 to 10 million, where we already kind of hesitate if it makes sense to start at that level. My question is, what advice, recommendations do you have for a startup to really judge on the capital needs, how to put a number to that?
Yeah, and this kind of comes back to the argument of having a good finance director or even a part-time finance director that's accustomed to thinking those things through. And it depends on the type of business, the stage that it's at. But one of my favorite examples here was a business that actually was very early stage, projecting into the unknown, which again, most businesses really struggle, and most people really struggle, projecting into a vacuum. But the company did a really good job of saying, actually, here are the key dimensions of a forecast. Here's our forecast, but here's the model. So we don't expect you to agree with our assumptions, but here are the assumptions. Put your own numbers in, and here's the model. Play with it and see what you think. And it was a consumer-driven business, They had actually built a nice S-curve for the adoption cycle. And you could put in numbers for how quick you think adoption is going to be, where the inflection point is going to be, how it interacts with pricing, how it's going to grow quarter on quarter. So they weren't saying we've made up some numbers and expect you to believe them. They were saying, actually, we've given a lot of thought to the mechanics of how this is going to work. Here's what we think the numbers are in terms of the range, but play with it yourself and see what you think. And I quite like that.
All right.
Great. So we've got 4 more questions. So we're going to take Peter, Marek, Volker, and then Chris. Peter.
Yeah, thank you for your presentation. So Tim, it's always when it gets down to it. So what is the internal rate of return you expect as a venture capital? I mean, you talked about everything, but exactly the bottom line. So what do you need?
Again, it's really quite a challenging question to answer generically because every fund will think of it slightly differently. But if you look at it from a kind of normal venture capital perspective, you're talking about 35% IRR, ideally. But actually, when you get into the details for some more mature businesses, actually 20%, is probably going to be okay. But a lot of funds, and our fund in particular, tends to look at it purely in money multiple terms. And that's because the IRR piece is driven by time. And our fund, and increasingly, I think you're starting to find funds in that sort of patient category, where sure, the time factor is important, but we have scope. We're not tied to a specific 10-year time cycle in a fund. We have scope on the time frame over which we support businesses, and it's possibly better to think about the money multiple return, and specifically when you're looking at balancing the return with the risk profile, often thinking about it in money multiples is better.
And those are?
Depends on the risk profile. So if you've got a business that is, and if I look at BGF, the majority of our investments are well into revenue generation, usually approaching break even, if not past break even. And from an investor perspective, we tend to, on average, generate a 2 to 2.2 times return on those investments. If you think about that risk profile and you back it down to a pre-revenue business, what return do you need to be able to see to justify that quite significant additional risk at a pre-revenue stage? The figure that everybody always lands on somehow is 10 times. But, it's got to be somehow proportionate to that level of risk.
Appreciate it. Thank you.
Okay. Thank you very much. Marek?
Thanks a lot, Tim. First of all, kudos to the moonwalking setup that you got there. This is amazing. Really great.
I'll send you the link.
Cool. Question: you were talking about different sizes and different maturities of the companies. So, what is the focus on your end? Which companies do you tend to focus more on and lean towards to, and how much of this venture studio approach or a hands-on approach inside you take into consideration when working with companies?
So, I think the studio approach is really out of scope for us. Which I think is often unfortunate because you see a lot of great opportunities and people and you think I can put all these things together. But our model, again, is just unique to us. Our model is really about backing a team and backing that team strategy. And part of the challenge is the volume that we do. So I have on the early stage side a team of 7 people. We're doing 14 or 15 deals this year. We have a portfolio of 60. On the early stage side. In the wider BGF, we have a portfolio of about 350 companies. So for all of BGF this year, we're probably doing 60 new investments. We had 45 exits this year. So you can imagine the chaos that's going on in terms of supporting the portfolio, doing the deals, handling the exits.
I'm questioning just to follow on a question from my side to clarify, because the points that you made about the key opinion leaders, the validating of the market size when it comes to the product market fit, I completely agree with you. But when looking, still coming back to the focus of ours of early stage photonic companies, you really lack these type of experiences in a lot of cases, that you need to figure out how, and we like the term, the team becomes consciously incompetent. So they can give you an aspect of factors that they know they will need to fill in the gaps in the team's experiences, or the people or the companies they will need to work with in the value chain to make the investment case stick for the investors. So this is why I was asking about the stages of the companies that you're working with, to figure out how do you mend to find those key success factors in the companies that are not yet ready, and do you send them off with a ticket, fill in those gaps, and then come back to us, or there's a
so sometimes it is, here's some constructive feedback, see you next year. But, one of the things that we do, which probably is verging on that venture, kind of studio model, and this is something we've borrowed from our colleagues who focus on the more private equity end of the spectrum. Every deal, we try to place a non-executive chair into the business. And so, if you've got, great science, kind of great early promise from a product perspective and an insight, to the market, finding a chair who's been through the loop once or twice can be really quite transformational. And it's not super easy to get right, but when you get it right, it's really great. And then you can kind of leave them to do some of that heavy lifting.
Great, thank you very much for that. So Volker. Oh, you're muted. You can't hear. Muted.
Yeah, Carlos, thank you very much. Tim, great talk. Thank you very much. So my interest is a different one. We just finished beginning of this year our financing round with a double-digit million amount, and we are active in the field of semiconductor business. And I think we knocked at about more than 100 doors to get money. And what we figured out is that although the investors claim that they invest into deep tech companies and into hardware companies, that in the end, so we always got the question, you're not doing software, you're not doing artificial intelligence. So most of the investors follow the mainstream. And so my question is really, how do you pick the big new ideas aside the mainstream?
Yeah, it's a really great question. It's a great point, and you're absolutely right. There aren't that many investors who are willing to grapple with the hard stuff. And I think, as evidence, you can look at the number of family office investors that are often required, on the life sciences side or deep tech side, to back, the really important stuff. And again, one of the key things for me, and really I'd say the reason I'm at BGF is I always found that particularly frustrating. BGF was set up to fill a gap in the market. And the original mission from a BGF perspective was just to support British small and medium-sized enterprises. I, in actually crafting the early stage strategy for BGF, have applied that same thing to say, if we do early stage, we also need to be filling gaps in the market. Where are there gaps in the market? My high level strategy is that, you probably will do better by focusing on the things that everybody else isn't focused on. But, at the same time, there is that satisfaction of fulfilling a market need. And for us, I think there's an ideal intersection where you get, companies with great technology, great intellectual property, and a great insight into a market need, a market opportunity. And then if you can add to that mix, somebody who could actually put together a playbook to take the technology to that opportunity, for us, those are our core requirements.
Okay. Thank you very much.
Thank you very much. Thank you. Chris Yates, a colleague of Vision Ventures from Gabriel.
Hi, Carlos, and thanks, Tim. It's more of a comment, really, and I'll try and be quick because I guess you're running there. It's mainly because I think you raised an important point, Tim, at the beginning by saying that important to reflect or understand the needs of the investor. And we have the luxury at Vision Ventures. We're working both on buy side, sell side, and for investors, so effectively all sides of the table. So this kind of comment comes up a few times, and I just like to outline a little bit how we think about this, that actually it's about three perspectives. And the fundamental is really the purpose of raising capital is to fund the business, presumably for growth or whatever, and that's ultimately what capital is required for the company in order to grow. The other side is exactly as you mentioned there, is in order to secure a particular investment side, equity investment coming in, it needs to reflect the needs of that person providing the equity, which is your ROI, effectively also recognizing what stage it's at of the business. And the third point is to recognize the needs of the shareholders, which is typically the founders of what they may want to do with their own risk appetite, how big, how aggressive they want to grow the business. And those we really see as the 3 points. And if all those three can match and come together cohesively in a business plan, then I think you have a good basis for things working. That was the comment, but great.
I would agree. I would agree. Yeah.
Okay. Thank you very much for that. So I think I will write already an article with what Noel Moore, what you wrote, your clear points. Your presentation was very clear points. You know, it's like, it reminds me of the book of Milton Chung that you had mentioned, you know, very simple, but that's just what it is. And you also mentioned Frank Levinson, a good epic friend. And also here, your presentation, well, your discussion team, very clear points. I will write an article based on that and submit it to you. Tim, thank you for sharing that. Just to remind, BGF only invest in UK companies, correct? Because I have people already asking you, but you only invest into UK companies. So I'll just specify.
UK and Ireland. But
UK and Ireland companies. That's one of the specificities. But thank you for engaging with us. I mean, we like to deal with people who are experienced, who understands photonics. So that's you. So that's great. And congratulations on your exit on the acquisition of Luminosity by Microsoft. I think you love even more photonics now. Great. Thank you very much for having you with us. Let's go on to the next speaker, Ronald Mueller, member of EPIC also. And I love your title. It's the 5-phase playbook. So, you know, I guess that's going to also end up into in an article. Your floor is yours.
Thank you, Carlos. Yeah, happy to contribute to whatever content you want to make out of this. Yeah, so be prepared for another number of bullet points here in this slides. Each of those bullet points might be good to go about for 10 minutes each, but I will try to, or in light of the time, I will keep it on a relatively high level and feeding into quite a lot of things that Noel and Tim already pointed out. So what we are doing at Vision Markets, we are a consulting house that's dedicated to the global vision market. And when I say vision, that also touches a lot of imaging, as you can imagine, and also has some arms and branches into the photonics world. So I'm happy to be here in this very interesting community. What we do specifically for these markets are 4 business lines. One is strategy. This is where we are doing market research, quantitative market analysis. Yeah,
I'm going to be nice to you, and I'm going to tell you now that you have not yet shared your presentation. Yeah.
Is that true?
Yes, you're not. I realized you were kind of going through. No, if you can share your PowerPoint.
Okay, thank you. I thought it did it. Okay, give me a sec. What's that? Okay, check. Good.
There, it's
coming up now.
There it is. It's all yours. Yeah, there you go.
Yeah. Oh, okay. Good. Thanks for pointing that out. Good. Yeah. So moving on here. That's the title slide. I think that's what you've seen. Right. So again, Vision Markets is a company that's focusing on the vision industry, and we are having 4 business lines. Again, strategy involves commercial strategies, business strategies, technology strategies, involves also quantitative market studies. We are having a flagship report, so to say, that annually monitors the growth of the components markets in the vision industry. So cameras, lenses, lights, and all that kind of things that go into vision systems. The second line is M&A, as you can imagine. So we are also consulting buy side and sell side customers, a lot of private equities, a lot of strategic investors, but also on the buy side, family companies, you know, all these wonderful companies that have been founded somewhere the early 2010 years or earlier. We will go into that later, and having a solid business, and then at some point thinking about an exit. And what fits very well into all these activities, as you can imagine, is recruitment consulting and marketing consulting. So when a customer comes to us, especially a company wants to be sold, they say, we need more people to fill that roles, or we need our brand being evolved. That's what we can feed from our team directly to that kind of requests. Good. So I will leap over the next thing as we are having a shortage of time here. So, you know, timing in life is everything. And that's why I thought I give a little bit of economics insights here. So the often asked question is, when is a good time to sell the company? And we hear a lot of concerns by our clients and potential clients that they're wondering, is there a recession coming, and what's happening in 2023? So here you see just some bullets or some, let's say, data points specifically from the US market. And I admit that the US market is maybe the one which is most friendly from that perspective. The picture looks a little bit different in Europe. But here, when you look at jobless claims now in 2022 versus 2008, you see that we are on a low level and even a declining level. Industrial production, we had the dip in Corona times, but since then a massive leap up and no sign of recession at all at that point. When you want to grow your business, right, you're needing money. That's why we're here. One of the ways to get money is getting credits and the granting of credits. And here we also see since say 2022 quite a ramp up and a growth of such kind of credit lines. And also retail turnover has been growing ever since 2008 with the Corona dip. But also that's on a high level and stable and further growing. So from our perspective, and that's, you know, it's just very few data points, not the full picture, but those are the ones we wanted to share with you. And from our perspective, we are not seeing a recession coming, at least not a strong one, and certainly not in the US. Again, for Europe, it's a little bit different. And just a disclaimer, this is not an investment advice. That meaning, having said that, so to say, the time is ripe and time is good to think about investments and or say divestments when you're thinking about selling your company. So what I wanted to share with you today is this 5-phased approach, which is coming from our experience sitting on the buy side with strategic investors and financial investors, as well as on the sell side. And here that approach is designed, so to say, for the sell side. So for you, if you are an owner of a company and you wanna, or you are thinking about exiting for your retirement or exiting to accelerate your growth, that's so to say the plan that we follow. Again, it's very high level. I guess no big surprises here, but we try to frame it in a conception here. And yeah, for as my predecessors already were thinking and talking quite a lot about, let's say the end of this game, we will focus here a little bit more on the opportunities and the strategy. And also saying upfront here, this process ideally starts 3 to 5 years before an exit is intended. Right, so let's jump into the phase 1. And here you see it's a lot of text, maybe. Each of these bullet points there's a lot of secret sauce behind that. Some of them are straightforward, obviously. And on the right bottom side, you will see, so to say, what the success factors are from our perspective in each phase and what the outcome is of each phase, so that you know, so to say, in which steps you are doing and where you are in the process. So the primary objective of this phase 1 that we call opportunities is, as Noel very well put it, it's getting to know yourself. So getting to know yourself not from your inside, so you know what your technology is, you know who your customers are, that's more or less fine. But the important part here is to get an impression on how does your company, does your business look like from the outside. What are your strengths and weaknesses, maybe in the technology side? That's maybe most known to most owners, as they are engineers by heart. They have been founding their companies originally because they had some bright technical idea and created solutions for that, or products and components for that. And so that's what they know by heart. They maybe have some patents there. That's typically the least of a discussion in our projects. But when it comes to marketing, how are you positioned? How is your company perceived from the outside? What are your strengths and weaknesses in sales? Do you act, so to say, opportunistic and come in or service every lead that is coming in on a trade show that is coming in through your website? And then on the way, you're finding out if that is something you want to service or not. Yeah, so that could be a strategy that is actually quite established and widespread in the industry. Might be having some, or might be raising some eyebrows when somebody is looking from the outside on that.
Ronald, since we have 2 minutes left, and I know that you have 4 more points to go, let's try to keep it to 1 minute max per phase.
Right. So I wanted to focus on those two phases in the front, as I said. Thank you, Carlos, for pointing that. Yeah. So that's really the focus here, and also especially when you're having multiple owners in your company, it's important here to align your views, to make sure what is critical for you when you are selling a company. Is it, we had the situation and one owner said, yeah, I just want to maximize the ROI. I just want to maximize the transaction volume and get as much money as I possibly can. The other owner said, well, but this is my baby. I've been growing this, this is my company. I want it to live on and thrive further. So, those are these sentiments and these conditions and criteria that you are and need to become clear of to understand what makes a successful sale of your company. So just an overview, so to say, when you are thinking about what are your opportunities, what are the investors that might come into question for you. So here you have on the left side the financial investors, financial private equities. On the right side, you have the pure strategic investors. Each of those investor types, and they are very broad and very high level, have different requirements, different criteria to invest. May it be on the ticket size, may it be on the profitability of the company, may it be on the business potential, or and especially on for strategic investors, on the synergies between your existing business and the investor's existing business. And that's something you should reflect on when you are looking at your company and understanding the opportunities. So on the strategy side, again, very briefly on that, this has 2 aspects to it. And when you are coming in and you're starting on a very early stage, you can maximize, you want to maximize your company valuation. And there you need to think about what is actually achievable. What can you do in the time frame that you give yourself, 1, 2, 3, 4, 5 years? What can you achieve to maximize your valuation? On the other hand, you have the target investors that you want to acquire, and those target investors' purchasing criteria. And that feeds again back to your valuation, because if the more you are meeting these purchasing criteria, the better your value and the higher your valuation is going to be. So again, there are detailed slides I'm going to be sharing later on. Again, here it's really important as an outcome that you maximize the attractiveness for target investors. So as my predecessors already said, it's really important that you look in yourself from the outside. And also you should make sure that you minimize the daily stress from such change projects that are going into the maximization of your valuation. That's a resource problem that you need to solve. On the strategy to acquire target investors, again, here it's important that you hide your plans, so you stay anonymous as long as you potentially can. You make sure that you're acting based on knowledge and not based on guesses. And really prepare is why we say, is because other than with your products, where you might have thousands of customers outside and out there in the world, investors, you maybe have a handful or a dozen of investors. So you need to make sure that this sales of your company, look at it as a product, right? Your company is a product. When you want to sell it, you have a very limited amount of customers, and you need to make sure that you get it right in the first time. That's having said about that, there is much more that we can be talking about. Yeah, campaign needs to be synchronized in time. The due diligence, again, really, I can just recommend that you are getting external advice by experts who are doing that, and not, learning by doing is not the way to go here. And same as the bidding process and the deal closing. There are lots of things to be considered. You can read it up. I think it's relatively self-explanatory. Also happy to answer questions on that in the Q&A session. Right, so far about that. There are also my contact details. Open for questions.
Super, that gives us time for questions. Let me see in the audience who has her hand raised up. I see something in the chat. So questions for Ronald. I know it was extremely detailed. And as I said, we'll write an article on that because I'm sure we can do that.
Sure.
Any questions?
I do have one question. Interested in your point there, Ronald, about staying secret or staying hidden. Can you just elaborate on that a little bit more, please?
Sure, yeah. Well, I mean, just recently there was a company being acquired in Germany, which has been on the market for, I would say, like 4 years. And when the rumors spread around that a company is for sale, and it takes 1 year, maybe 2 years, and it's still not sold. So you're getting, people getting suspicious, investors getting suspicious and say, okay, shall I really burn my fingers again, as so many others did before, or should I maybe back off? So that's why, again, it's very helpful to get an external consultant, and we are doing that repeatedly, to say, okay, can you test the waters for me with these and these investors? Are they potentially interested in someone who has our profile, not disclosing what the actual company name is, just the profile? And yeah, so that's the point here, which is very helpful and important to be considered, as so many others. But yeah, thank you for pointing that out.
Thank you.
Okay, if there are no other questions, then that's a perfect introduction for the next speaker. Frank, why don't you just take over? Ronald, if you can stop sharing your slides. You're still showing our screen. If you can, then I will just give it over to Frank. Frank Smyth, who is the CTO at Pilot Photonics and one of the founders or co-founders, I believe, as well. Correct? Oh, you muted yourself, sorry. Or we muted you, I don't know, Frank. You have to mute yourself and start sharing the screen. Well, it worked during the rehearsal. There we go.
Now making progress.
Yes. So you can start sharing your screen. Were you not? You were one of the founder or the co-founder, correct?
I was a co-founder. Yeah, exactly. There were it was out of my postdoc, and there were a number of us, 5 of us initially, but the other guys remained within the university.
Any regrets? It's not a question.
Not in the slightest, not in the slightest. I am having a bit of trouble with the app here, though. Just give me 1 second. I don't know.
Okay. Well, maybe Frank is like one of those like me. I'm unable to do 2 things. You know, I'm trying to talk to him to fill the time, but I would be unable to do that. So you just focus on sharing the thing. We'll just wait.
Yeah, the Zoom isn't showing up in the thing. Just give me 1 second. Apologies. No, we should have.
There, I can see. There it goes. It's all yours.
Apologies for that. Yeah, thanks, Carlos, for the introduction, and thanks for the opportunity to speak today. Very, very interesting and relevant talk so far. So thanks to all the speakers. Let's start with a quick bit of background about Pilot Photonics. So we are a spin out, as Carlos just mentioned, from Dublin City University originally. And we spun out during my postdoc. We're focused on comb laser technology and photonic integration. We've 20 staff now, predominantly physicists and engineers. And we've raised about 5 million in angel and VC funding to date, and about the same again in kind of public funding to leverage that. we have a kind of a full stack photonics, as we describe it, in our ability to deliver full photonic solutions, everything from the kind of epitaxial material design all the way up through the PIC design, RF and electronics, and all the way up to the software, so to be able to deliver a full solution. And really what we like to do is apply our comb-enhanced PIC technologies to solve tough problems in kind of impactful areas. That's our vision and mission. So these are the kind of market areas that we look at, pretty much anywhere, like broadly defined as the digital transformation. I don't particularly like that term, but basically anywhere that digital technologies can have a positive impact on our lives and business. And we're applying these single chip photonic integrated circuits enhanced with comb laser technology. We have a number of different products ranging from kind of chip level all the way up to full instruments and modules. And these are targeted primarily at the comms applications, but also a bit in sensing, in LiDAR, and in the kind of space industry as well. Okay, so that's a quick bit about the company. Our funding history, I'll talk through. We started initially back in, well, we founded the company in 2011 and just raised a pre-seed round of investment back in 2012 from Enterprise Ireland and a couple of the other Irish seed capital funds, as well as the founders. We subsequently won a nice FP7 grant. At that time, I suppose we were focused on our technology as an R&D instrument, and maybe it wasn't the largest or most exciting opportunity for investors. So we kind of structured the company then based on that FP7 grant to start focusing on photonic integration and the high growth market area. And out of that project, we ended up with kind of PIC prototypes, I suppose, and it was these and the traction that we were able to gain based on these that allowed us to raise our seed round initially in 2017, and then some more angels got involved in 2019. And then beyond that, this is a round that we're just closing at the moment. It's been open for most of the year. It's been oversubscribed, and we expect to close it in January. And this was kind of funded by many of the players that were already at the table, and then Infinity Capital, a new investor, joined as well. So that's been our kind of general funding history, and as I said, we've leveraged that quite significantly with more than another 5 million in public R&D funding, in particular. The EIC accelerator, or the SME instrument, phase 2 as it was previously known, which is a single entity award worth more than 2 million. So that was a big deal for the company as well. So what I wanted to do is just kind of touch into each of those rounds, or each of those kind of stages of growth, I suppose, and mention what I feel were some of the pivotal items for raising money at those stages. So certainly at kind of seed round stage, we had a lot of large companies, big names, showing interest in our technology, and we got great letters of support and used these extensively in both our business plans and pitches, but also in our funding applications, and they were very valuable, and it showed we were punching above our weight, but also that there was a large market opportunity there. Our investors carried out some very positive due diligence on us with their own kind of within their own network, I suppose. One more from a kind of, let's say, communications industry veteran, I would say, who recognized the potential of the technology, and another from an adjacent industry, but who was kind of very experienced at picking apart patents, really, and both of those gave very strong references, I would say, on our company and the investability. This is one from an earlier part of the company's history, but I think it's always an important one, particularly for university spinouts, is ensuring that the equity structure makes it an investable proposition. So after the university itself and tenured academics, there needs to be sufficient capital or equity available for the kind of full-time team who are driving the business forward. And often this isn't the case, and it actually is a pretty significant problem, and one that needs to be resolved very early on, because the later you leave it to resolve, the more difficult it gets. And then I think another aspect that was helpful in raising our seed round was the fact that we were now starting to win funding from the likes of the European Space Agency and other bodies. And I think this is something that can worry investors, because it can be thought of as a distraction. But once this is well aligned to your strategy, then I think it's a bit of a no-brainer. It reduces the risk for the investor, and it increases the company's runway and things like that. So I think these were important points for raising our seed round. Then I suppose when you're moving towards Series A, things are getting a little bit more serious. You need to be able to show product market fit and an ability to scale. So in our case now, I suppose you're moving from not just interest or letters of support, but to actual traction. So tier 1 customers paying money for your product or your service offering. As well as in our case, we had some really nice kind of third-party validation. So in the form of market analyst reports from the likes of Frost & Sullivan and Nature paper featuring our technology and things like that, that just fill out the story and give further data points to an investor. I think it's critical at this stage for a company to be showing the potential to scale, and it can't do that if everything has to go through one person. So by now we had built out a strong and experienced management team, brought in a CEO who had previously scaled and exited technology companies, and we also switched out the existing board of directors who were, let's say, a number of members of the founding team, much more kind of academic and technically focused, into the current board of directors, which is very kind of commercially focused and experienced in this side of things. We also needed to be able to show that both the technology and the organization was scalable. So one of the other speakers touched on this, but what was the word? I think it was Marek mentioned it. Consciously incompetent. So I liked that one. That was basically knowing your limits and recognizing your strengths and accepting your weaknesses and partnering in the right areas. So we've gotten very deeply involved in the Photonics and the PIC ecosystem within Europe and made some great partnerships there. We've kind of doubled down, I would say, on monolithic 3.5 as the right platform for our technology. It plays well into all of our strengths. And that's on the kind of technology side, but then even on the organization side, we've got to be able to show the ability to scale. And so through the SME instrument grant that I mentioned earlier on, Europe provided us with a business coach for 12 months, and that was a really excellent step that we took that kind of shifted the mindset of the company, I would say, from a more academic or university kind of mindset into a commercially focused and created this very strong positive growth culture that we have, and kind of established, let's say, the frameworks and the structures for career path and for reward, as well as kind of things like accountability and stuff like that. That was really positive step that we took there. And then the final one is something that a couple of the other speakers mentioned as well. We call it corporate cleanliness, and we pride ourselves on it. It's something that we think is very important, but it's really the minimizing any obstacles to future transactions. That's how I would describe it. So making sure all the I's are dotted and the T's crossed, that there's no kind of loose ends and things like that. So this is around, let's say, clear title to intellectual property, clean kind of unqualified audit trail, no legal disputes, all those kind of things that could upset future deals. And I think that's a critical thing to get right around this stage as well. And so where are we now? So I think one thing that we haven't we've kind of tended to fly a little bit under the radar, I would say, in the industry. So we're now making a big effort to raise the company profile. This was started at ECOC this year. And we had a very successful show, our largest kind of investment in a trade show to date. So very pleased with how that went. Our full focus within the company is on kind of technology development and ensuring that it's volume producible and scalable. So we're getting involved. We're moving from, let's say, multi-project wafer runs into pilot line runs, dedicated runs, and design of experiment runs, ensuring that we have sufficient number of kind of samples available for qualification. And we're starting to do some in-house reliability testing and all those kind of things. And we do work with a kind of global manufacturing partner, so that when the time comes to ramp up production, we're switched on, the products are designed for manufacture and ready to go. And so the final aspect to that then is the big one, kind of winning evaluations with customers. We now have tier 1 players evaluating our technology and kind of designing comb-based picks into their next generation products. So that's really nice, and it's exciting times for the company. So thanks for your time and attention, and happy to answer any questions you might have.
Super, thank you very much. Before Noel, I think I saw a question, but maybe she backed off. But Betsy, I saw that you raised a hand, but then you took it down. So I don't know. You want to ask a question or not?
I can ask two short questions. When you emerged out of the university, what range of shares were the founders left with when the university took their portion? What portion did the university take? Because in the Netherlands, we think that it's pretty high. And I just want to know, for a point of reference, in Ireland, what did they take?
And if you don't want to answer specifically, you can just make a generic
range.
What would be a range?
It's an absolutely fair question. And the range, it differs from university to university, but I've heard of anything from 15% down to 5%, depending on like the IP, let's say, that's going in, or how long the technology has been developed and stuff like that.
Yeah, it's much higher here, just to be clear.
Okay. Yeah,
and then the other question is maybe for the investors. We recently received a seal of excellence on our EIC application. We are awaiting the final. We got the opportunity to have a second interview regarding our project, which we had on November 22nd. I'm just wondering, what is a seal? I mean, we haven't publicized the seal of excellence because we kind of see it as a, thanks for participating. Is there any way, kind of prize? Do any investors take credence? Do they give that any value? A seal of excellence versus the actual award?
I'm not sure if that's directed at me. We did use that quite a couple of times, but actually we applied 4 times and won that award on the 4th attempt. So that's a bit of a keep going, you'll get there sort of message. I think it's valuable. It means, well, from Europe's perspective, they're stating that you're a very investable technology, and just fell short from a kind of available capital, let's say, within the system to fund everything that they deem fundable. So I would use it, but I wouldn't give up and keep plugging away.
Yeah, thank you.
Thank you very much, Betsy. Noel, and then we'll have Mirela and Claudia. Noel.
Hi, Frank. Quick question for you, Frank. I know that you, based on the thing on the screen here, you work with some very, very big and influential end users. And I want to know, how do you stop yourself being dragged into a hole developing something for them without being paid for it, as a proof of concept or whatever else? And how do you get them from, that's a nice technology, to something more than a letter of support, like an actual order? I think a lot of people in your level or prior to your level, that's like the holy grail. How do you go have a conversation with the Googles or Apples of the world and say, hey, listen, guys, this is a really innovative technology that you haven't seen before, and we'd like you to pay for it? Because that's a big thing.
Yeah. No, that's a great question, and one that we definitely did struggle with for quite a while. And actually, it was when our new CEO came in, one of the, let's say, challenges that he recognized immediately was reducing customer friction. So that what that was about was developing and enabling a platform that allowed us to very easily get prototypes of our technology, prototypes of our chips into these customers' hands and into the large labs, and getting them and then it's a, let's say, smaller amount of money. It's essentially like our instrument sales line, but your technology is now in that customer's hands. You're registered within their, let's say, a supplier list and things like that, and now they're able to test the technology and see if it really does provide value in their application. So that's something that we took on, and then it's easier for it to grow legs once you have something in their hands. So that was a key step that we took there.
But that must have meant you have to take certain customers and say, okay, we're not going to work with those guys because it's too customized or too different, whatever. You probably have to focus down the product a little bit. Is that right? Is that what I'm hearing?
We have done. Yeah, absolutely. It's we've kind of, and actually a couple of different things. So on both the, let's say, we have these two kind of lines, an instrument line that we use both as an R&D tool, but also as this kind of a beachhead into larger customers. And yes, we've stripped that down into not quite a one size fits all, but no customizations unless the opportunity really makes that worthwhile. And then on the photonic integrated circuit side of things, we have really honed the offering into something that is very much applicable into, let's say, the next generation of coherent transceivers. But the very same architecture is also proven a hit with, let's say, the SATCOM and the mobile 5G, 6G guys. So it's definitely honing the product architecture and offering, and not trying to do all things for all people. Yeah.
Awesome. Congratulations, Frank. Well done.
Thanks.
Thank you very much. We have a question from Mirela Koleva, but I'm going to ask you to unmute yourself and ask the question yourself, Mirela. It's nice to hear and see you if it's not too early for you in Canada. It's a nice coincidence that we talked on Sunday and here you are again. So thank you for joining us. Are you there somewhere, Mirela? I know it's pretty early. You raised your hand. I don't want you to raise your hand. I want you to unmute yourself and to ask the question yourself. But, you know, with all of these little icons, I cannot find you. Where are you? Mirela, I feel like, you know, Mirela, are you here somewhere? Well, I'm going to let you the time to unmute yourself, but I saw also Claudia, you raised a hand at some point. You have a question? Yeah, you're muted. You're muted, Claudia. No, you're again unmuted. So it was unmute. Let's give that a shot. We seem to have ghosts.
Yes, sorry, thanks for your patience. I wanted to follow up on the question on the topic of the board of directors, because you mentioned you restructured it, trying to make it more commercially oriented. Can you elaborate on this? Like, how many members of the board do you have? How is it structured? What do you recommend?
Yeah, so we have five members of the board of directors. All are all apart from the chairman are shareholders, and two are represented by the investors, two of the management team, and then a non-executive chair. And we've kind of kept it quite small, but it's very effective, I would say. In the past, the board was made up primarily from the founding team, as well as an independent chair, and these were all, let's say, the technology experts, very appropriate to that time of the company's development, where it was all about the technology development and application and use case development and that kind of thing. But now a very commercial board is what the company needs right now, from the point of view of scaling, raising funding, etc.
Mm-hmm. And the independent you don't have anymore. So Like you have 2 of the management team, 2 from the investors,
and an independent chair. Yeah.
Independent, but still shareholder.
The independent chair, so not a shareholder.
Okay, yeah, got it. Thank you.
And I like that you ask these very concrete questions. I'm very sad. One of our members has a big European corporate VC taking 15%, and for that they get 1 seat on the board. Turns out that now they have 4 board members, that 15% only, and he happens to have the chairman from the same company. Now they've got 2 out of 4. They convince 1 other guy, and they've got 3 out of the 4, and then now the guy is out, which saddens me very much. He brought the company to a certain level, and when it's to scale up something. So, I like it when we learn from each other. Mirella, we found you in the other room.
Thank you. Hello, Frank. Thank you very much for your very comprehensive, interesting presentation. It's really fascinating to learn about your journey. My question was very much along the lines of what Noel already asked, and I think my original question was answered, but I do have a follow-up question. I was wondering whether you could expand a little bit about how you actually got those prototype chips into Google's hands, into NEC's hands. I would really appreciate that.
Sure. So at that stage, those letters of support in the initial days were mainly based on slides. It was a concept at that stage. More recently, we have chips in tier 1 customer hands, and those have been fabricated through the JEPIX ecosystem primarily, as well as directly engaged with one of the other European 3.5 fabs. So that's been the process, making prototypes, small quantities, multi-project wafer runs, and putting those through through this process that I mentioned earlier around reducing customer friction and fast prototyping. We've done some kind of internal fiber attach and things like that, so that not every prototype turn that you need to make costs, I don't know, tens of thousands of euros. So being able to kind of turn those fast prototypes and get them into customers' hands is critical, I would say. So that's been the process, I would say. Gather interest at as early a stage as possible. Gather interest from the big companies. It can be a little bit daunting, but you have to be brave and socialize your idea. Take feedback from the market. I mean, we're still to this day very much responsive to the feedback from the market, and you have to be. And if you get positive engagement, positive traction, ask them to give you a little quote or a letter at an early stage, and then push your technology as soon as you have a minimum viable prototype or something like that available. Push it to them at a way that they can easily consume, then eventually you will be turning that into real kind of development efforts and NRE engagements and hopefully design-in wins.
I see. So my specific question is more, so you didn't have direct connections with all these massive technology giants in the beginning, I assume.
Yeah.
You did the word of your... Yes.
It was really through the kind of conferences, through the trade shows, and just being brave and going up and trying to catch someone after they give a talk or something like that that's relevant to your technology, saying, look, this is what we have. You have to have a kind of a 30-second elevator pitch to reel off, try to get a business card, and it's just kind of standard business development stuff. I think Noel would be a better man to describe it than I would, but it's really about just putting yourself out there. The trade shows, particularly the let's say market watch sessions, I certainly tend to kind of as I got involved more on the commercial side of things, move away from, let's say, the pure conference, the technical sessions, and more towards the market watch sessions, that closer to market stuff. And you really learn a lot, but you can also meet a lot of people. People are very accessible, very helpful at those kind of sessions. So
that's great. Those are great concrete tips. So last comment from Jochen, and what I suggest, Mirela, tell us these end users who you would like to. Let's find an Epic meeting which is relevant for them and get them to the Epic meetings, because the Epic meetings provide lots of opportunities for you to talk very nicely with them. Jochen, final question to you before we move to our next practical experience speaker.
Hey, thanks. I would be interested in the content of the letter of support. So what I'm observing right now, so we are also in discussion with a big corporate, and I can tell you it's a kind of a dance. It's, of course, we want to have something tangible in there, something that the company commits, but I want to learn more about what kind of content ended up in this letter of support, and how did you achieve that?
Well, it was mainly a request from our side. Would you be willing to test this technology if and when we put it in your hands? That's effectively it. And look, these are busy people. Often, if you can help draft a letter, and they will then tweak it to within the bounds of what they're permitted to within the company and things like that. Often they'll have to get authority from somebody for final sign off and things. But people tend to be quite helpful and willing to support you and things like that. I think particularly when they see kind of startups with interesting or exciting technology, it's beneficial for them if they can introduce that to the company as well. So they're keen to help.
That means it was, in fact, the content was about that they are impressed about the technology and that they see the potential of the technology. That was mainly the content.
Both that it can play a role in large opportunities in future markets, next generation technologies and things like that, and then ideally you want to say that yes, if you can ship us one, we'll test it.
Great, thank you very much for that. So let's move on to our last speaker, Boudewijn from Effect Photonics. I believe you were the co-founder, CTO. I think now you're the president, which is another position. But you're the CTO and co-founder of Effect Photonics. Again, somebody who has a real experience into the whole thing. And you can tell us, of course, how long the company has been there and all of that, and what stages you have been through in fundraising. The floor is yours.
All right. Well, thank you very much. And thanks all the others for a very interesting presentation so far, especially the last one, Frank. A lot of familiar phases we also went through. So yeah, I want to share some of the lessons that we learned, not just in Effect Photonics, but also some of the things that I see here in Eindhoven when looking at other startups coming out of the university. I'm coaching a couple of them. So yeah, but first, let's start with Effect Photonics. Let me introduce the company very briefly. For those that don't know us, we make optical transceivers for fiber optic networks. And our optical transceivers, inside there is PIC technology, and also recently acquired DSP technology. And those two technology building blocks allow us to basically bring high capacity to the edges of the network. So we bring WDM technology to the edges, but also coherent technology to the areas where volumes are high, costs need to be low, and of course that fits very well with our semiconductor technology. We have a team of about 120 people. We have global presence. We have office in the Netherlands, Eindhoven, but also recently moved to the US. We have an office in close to Boston, in Maynard. We also have an office in Cleveland, where our acquired DSP team is located, and an office in Taiwan focused on mostly chain management. We also have offices in the UK, but we are actually scaling those down. We used to have sort of our own manufacturing facilities down in Devon. But recently we made a bit of a pivot, and I'll come back to that later on, in our manufacturing strategy and working more with external partners right now. But if we go back to sort of the start, we started in Eindhoven as a spin-off from the Technical University here in 2010. We, until today, raised a total of more than 95 million euros in both venture capital and private equity rounds. So yeah, quite some experience with the different stages of funding. If we go back, if we go quickly through it, so in 2010, spin-off from the university, that first phase was very much funded with seed loans, either out of the university or from, let's say, the local region. That allows us to basically build the first hardware prototypes, the first hardware, show that to customers, get the first customer interactions, get the first sort of little sample sales with some of the household names that were just mentioned, that we're willing to both evaluate the technology and pay for it, and that really helps you to trigger sort of the interest of serious investors. So then we did a Series A in 2014, end of 2014. That was our first venture capital round. I think, if I remember correctly, it was around 5 million euros. That was really allowed us really to start the proper product development, more customer interactions, also really start having sort of that serious conversation with the customers. Okay, what does the product really need to deliver? What is where is the core of your problem that our product needs to solve? That then led to our Series B VC round in 2018. Actually, all of these rounds were, it was not just one round. It was typically, as you are sort of running out of cash, but also getting the first interest, the first investors involved, you typically then set up a convertible loan with some of those investors that are willing to step in earlier. Then you do your round. And then sometimes afterwards you go like, either you leave it open for other people that want to join. So that was the case in our Series A. Once we had our first close, there were other investors that then suddenly said, hey, can I still join in and give us a bit more money? But basically our Series B was around 2018. That basically allowed us to really start a serious effort into industrializing our technology. So really focused on scaling up, putting in the right partnerships, but also focus on reliability, getting your yields up, your testing strategy, etc. That was actually a long phase, and I think this is a phase that is easily underestimated. Right? Once you have your first prototypes out of, for example, an MPW run or a pilot line, that's just the start. If you go to a big tier 1 customer and you say, "Hey, we've produced this on a pilot line," you'll scare them away. They'll really run away. They come back when you have it in a proper fab and show me that this fab and this supply chain can really scale to the volumes that I need, and that you have also, again, a bit of a hybrid round. It's also the first time that we actually got a private equity investor on board, and also where we did our first acquisition. So we did an M&A deal that brought in our DSP technology in exchange for a strategic investment from Viasat, originally a satellite communications company that had this DSP design technology and saw the opportunity that to bring together sort of our PIC technology and their DSP technology. Some of the two is actually larger than the two separate. So they brought that in exchange for investment in their shareholder in our company as well. So out of this, what are some of the lessons learned? First of all, fundraising, it's a continuous process, and you really need to embrace that, right? As soon as you close the round, the next cycle starts. It's a continuous process because you're continuously getting involved with, engaged with investors. Many of them will say, "Oh, you're too early," or maybe not the right timing, or my fund isn't ready. But all of those conversations may play a role later on. So build your network. Warm introductions are always much better than putting in like a cold call or just sending in your business plan to an investor. I've never heard that working for anyone. So it's always sort of this warm introductions that need to happen. And second, if you're pitching for an investment, it's not a sales pitch, right? It's very different because if you're selling something, or if let's say you want to sell your house, right? You make it big, you point out all the positives. You don't mention sort of some of the negatives. Once the deal is done, you hand over the key, and then you go post your own ways. An investment, that's not the case. You're putting in, you're engaging on a partnership. You're engaging on the road together. So it's very different, and I think you actually need to be very honest about the risks and the gaps that are still there. And some of the previous speakers also mentioned this. If you spell out sort of an honest risk profile, you're actually helping the investor to actually make a decision. And if your risk is still too high, then you rather know that beforehand rather than afterwards, right? So spell out the risk profile, justify the valuation that you're asking for. But yeah, next one is think ahead and think big. And this is something that a lot of people always say, and think big. Of course, you need to project a good story, but that's not the point, right? It's not part of the sales pitch, but it's more challenge yourself. What if you would have all the money in the world? How would you structure your company? And it's an exercise to challenge yourself and to sort of anticipate on future pivots that may happen. So why are you doing things the way you do it today? And quite often the answer is, well, we're doing it like this because we're limited in money, or we cannot access the biggest customers yet because we don't have the credibility yet, for example, right? Or we're working with this supply chain because the big ones don't have the volume yet. But if you think sort of ahead, it also means that at some point you'll probably need to make a pivot, because in the end you do want to service those big customers, you do want to be a volume provider, etc. And it's perfectly fine, right? Many companies, all companies, goes through these number of pivot points, and investors will also understand that. So if you say, okay, if you plan for it, then you're prepared. So that's the next, or that's also basically connected to this. So you break it up into stages, be very clear, okay, we're now still in technology development phase, or we're now into product development phase, or we're now in industrialization phase, and investors will understand where you are. Then this was also mentioned before. Especially in Europe, you always have a mix of different investment types, right? Often you start with seed loans, you back it up with some kind of subsidy project, then you get your first VC investment in, and that can then leverage some public investment, or the other way around. You have a public investor that says, hey, we're willing to invest in this. We think this is really technology, but we cannot leave. You can use that sort of commitment when you're talking with a VC investor and say, look, if you're stepping in right now, you already have sort of a public investment ready to basically leverage that. So I guess these are some of the lessons learned, but I really want to end with this one, which is really what I think is the most important one. Investment is a partnership, and it goes both ways, right? You need to understand what your investor is trying to achieve. Of course, you both wanna make money. You both want to be successful, but you also want to make sure that you have an investor that understands your point of view, right? They understand. Most investors, luckily, understand that as a management team, you're driving the company. You're the biggest critical success factor of their investment. So if you have a very hard negotiation about valuation, about dilution, and share of the company is still left for the founders, and they don't understand that they need a founding team or a management team that is also incentivized, and they need, for example, experienced staff members that also get part of the equity and get part of the success, then you're probably not talking to the right investor. Good investors will understand that. So in the end, it's a partnership. You need to trust each other. You're in there for the long run, and if everything goes well, then also everybody shares in it. So with that, I'll leave it.
Sure. Sorry, thank you very much again, Boudewijn. I really like this real life story examples. Again, I don't know if you have done this presentation before, if you prepared it just for us, but I really like the spontaneity or the honesty or whatever you call it.
It's just for you.
Okay, well, thank you very much for doing that. Any questions or comments from the audience?
I have one, Boudewijn, if you don't mind. Was really interested and impressed to see the DSP acquisition this year. When did that come into your minds, and how did it emerge, if you can say?
Yeah, good question. And it wasn't that we were looking to acquire this. It was basically one of the things that was a critical component in our future product plans, and something that you can get on the market, you can get it off the shelf, or you can get it through partnerships. And was one of the things that we always thought, like, okay, we probably don't have enough money to commission our own specific
dedicated
design. However, it so came along that when we started talking to the Viasat team, because they do design services for other companies and have a good track record in the business. We then sort of started exploring. It was more of an explorative talk of, okay, how much would it cost if we would plan for it in the future? And then they said, well, but maybe, you know, this could be a synergy here, and one thing led to the other.
impressive. Congratulations.
I will write 5 articles. I didn't plan for that. I thought I was going to make 1 article summarizing the whole story over here, but I'm going to end up with 5 articles because you have shared so much of a rich content. If you don't have a final question for Boudewijn, then I'll just have 3 comments before we close up. But again, if you still have a question, we can still do that. What I would like to share with you is the following. I thought it was really so nice to learn from each other. Let's just remind that Epic has this website, Mentors in Photonics. And when you go into that website, you will see 100 CEOs who have all had that experience. Again, within the Epic community, we like to learn from each other. So feel free. Oh, here we have, I thought we had a Noel. So feel free to ask Epic to introduce you or to talk to each other, but let's learn all from each other. That was the first comment. The second one was again to thank the sponsors of this event. Well, not the sponsors, the organizers, these 3 EU projects, the fabulous JEPIX and that was a microbics and MedFab on the medical side. Thank you. I see Peter was going to help me out, but thank you for these 3 projects for sponsoring that. And I really enjoyed it. I have, as strange as this may sound, Epic has organized 200 online meetings. I think I have hardly ever moderated any of them, but I really enjoy that. I think it's a good tool to keep in touch. We had a physical meeting with the investors, I think in Eindhoven like a month ago. Now we have this online meeting and we still have the introductions by emails in between. Again, Epic, although we organize about 100 events per year, we're not an event organizer. We also organize events, but it's the purpose of connecting people and connecting these platforms for connecting, whether it's online, physical, by email, whatever. It all works. So I want to thank the speakers and the participants all. Thank you very much. If any of you has any closing remarks or questions, let me know, but I just appreciate everybody's contribution for sharing. Thank you. Oh, I can share something. Well, while you're kind of thinking about